Morning, everyone. Welcome to Hayward's latest in its series of webinars around the world of pension risk transfer. We'll just give a few people to come in through the lobby an extra few seconds, and then we'll kick off and I'll introduce you to our panel today. Okay, that looks like we've cleared down the lobby, so welcome and morning. So we're here to talk about the value that residual risk insurance brings to schemes. But we'll start off by introducing our panel. And representing our friends in the legal profession, we have Anna. Could you introduce yourself, please? Now you've taken a drink.
Hello, sorry. Anna Rogers. I'm the founder and senior partner of ARC Pensions Law, which does what it says on the tin. I've been doing pensions law for a very long time now and lived through all the developments in the areas where we're currently trying to backfix things that may come to light in these later stages of a scheme's life. And I've focused pretty much on well-funded, fully bought in, wanting to buy in, bought out and winding up schemes and the whole preparation for settlement and the actual accomplishment of settlement for quite a few years now, starting with bulk annuity transactions from 2007 onwards. Probably enough about me.
Thanks, Anna. Thanks for joining us as well. So representing our trustee community, I'll introduce you to Harris.
Morning, everybody. I'm Harris Wright. I'm the Managing Director of Capital Cranfield, and I am, the current chair of the Association of Professional Pension Trustees. I've been a trustee for 14 years, or worked in the professional trustee industry for 14 years, over which time I've completed about 25 buyouts as a trustee.
Thanks, Harris. And also, while we're here talking about insurance, seems fair to ask an insurer along. So please can I introduce you to Simon?
Good morning. I'm Simon Bramwell. So I'm in the business development team at Rothesay. And so Rothesay are we're a monoline insurer. All we do is write bulk annuity transactions. We're the largest of its kind. My job is to try and convince trustees and corporates to sort of entrust their scheme and members with us. Prior to Rothesay, I was on the other side of the fence, so advising trustees and corporates on looking at kind of pension risk transfer options, bulk annuity options, and the pros and cons of residual risk. So that's my background.
Thank you, Simon. I'm very excited for this conversation this morning because it's very rare I turn up to a Hayward webinar and not have to talk about my expertise. So I'm very glad to introduce you to my expert on PRT, which is Kelvin. And as you introduce yourself, Kelvin, perhaps you can tell us why we're here to talk about residual risk in particular.
Sure, certainly. Thanks, Chris. Morning, everyone. Kelvin Wilson, I've worked in the PRT space now for knocking on 20 odd years. I've advised trustees, advised corporates on all forms of risk transfer, swaps, BPAs, and I've also worked on the other side of the fence. I've worked with insurers selling BPAs. At my time, I worked at the Pru. I've also been involved in setting up the pension super fund in its original guise. And my role at Hayward is I'm the director of PRT, helping Hayward bring solutions, technological solutions into the PRT space. And I guess, we are here this morning to talk about residual risk because bulk purchase annuities or BPA insurance has been seen as the optimal way for sponsors to settle and trustees to secure their pension liabilities and benefits of scheme members for some time. However, a BPA, like all insurers, will only cover the members and policyholders set out in their schedule. And if entitled members and beneficiaries are overlooked, special promises or benefits are erroneously excluded, and or unexpected changes in law mean benefits should change. These risks, collectively known as residual risk, and I don't want to sort of preempt the discussion because we will get to defining what residual risk is, but these risks will typically not be covered by the standard BPA contract. Residual risk has traditionally been mitigated by trustee indemnity insurance and run-off cover. However, cover is limited by term, less than 15 years, and subject to often liability caps. As new entrants emerge and competition increases in the BPA space, more BPA insurers are starting to include residual risk cover as part of their BPA offering unlimited liability caps and at fairly unlimited time periods. So, and moreover, the threshold for residual risk cover, traditionally only offered on £500 million plus deals, has come down to deal sizes starting at 100 million. At a price of between 0.5% to 1% additional to the BPA premium, with uncapped coverage and offering trustee and employer peace of mind, why wouldn't all schemes pursuing BPA ask for residual risk included in their transaction? I guess this morning we are here to really try to find out exactly what does the residual risk mean for different parties and stakeholders in the PRT space. What does it mean for trustees? What is it that trustees are asking for when they request residual risk cover in their BPA contracts? What is it that the insurers are actually offering, and is it consistent with what the trustees are demanding? And then, with the cost of cover and the additional work that is involved, is it really value for money, and is it worth it? So that's what we're here to discuss this morning.
Thanks, Kelvin. All right, that's set the scene nicely. So let's ask our guests what they think then. I'm interested to draw out whether there are different perspectives on this from our relative communities. So starting with Anna, I'll ask you all. What do we mean by residual risk? Kelvin's sort of started to set the scene there. And what are the main indicators for even identifying residual risk?
I'll start with what we mean by residual risk. I think that it's quite misunderstood, and sponsors and trustees aren't always terribly clear what they're seeking here. People think and still talk about the statutory discharge, and they talk about winding up a scheme, and there's no more trustee, there's no more scheme, it doesn't exist anymore. So why are we worried about residual risk? Why do we want insurance and run-off cover? And the reason is because those things don't really protect the trustees, and they don't protect the sponsor if it has indemnified the trustees. So residual risk is an exposure, post-termination exposure to a claim for a benefit that hasn't been insured or otherwise secured or provided. And the best way to discharge a benefit is to pay it. Liability is to pay it. It could be paid out of the scheme, it could be insured, but there's always the risk with any defined benefit scheme of missing beneficiaries, completely unpaid or underpaid beneficiaries because the full correct benefits haven't been insured. And so residual risk, which started life being called all risks, I suppose, have come to mean a defined set of exposures, a subset of exposures where trustees could find they have a liability for a benefit after they've distributed all the assets and winding up. And clearly that's something they would like to protect themselves against. That's what residual risk means to me.
Thank you, Harris. Do you want to pick up on that from a trustee perspective?
Yeah, I mean, I wouldn't change. I'm absolutely agree with what Anna said in terms of what a definition is. I mean, from a trustee point of view, in terms of would we look for a residual risk transaction? Firstly, let me just pick up on a couple of points that Anna and Kelvin said, which was absolutely correct, in that this isn't new. In the past, it was called all risk buyouts. Now we're calling it residual risk. So it went out of fashion, and part of the reason it went out of fashion was lack of appetite from the insurers to provide it, but also residual risk or all risk buyouts are expensive. They are more expensive than your conventional buyout. So for sponsors, it was, well, we can't afford that. Now, from a trustee point of view, when you're determining whether or not you want to look at a residual risk or all risk buyout, you're really looking at how much confidence do you have in the data? How much confidence you have that actually you've identified all the members, you've identified all the benefits that they may or have, and identify any beneficiaries. And how confident are you that actually the benefits that you're paying are correct? We've seen with pension schemes over the past 10, 15, 20 years, they've moved from administrator to administrator. So you start to think, well, actually, have we really identified everybody in this transaction? And for some trustees and some sponsors, they're very confident that, yes, they have. And they wouldn't necessarily look at this because on the balance of probabilities, the risk that there might be a claim is relatively low in their eyes. For others, there's less confidence. And therefore, they might then say we would look for some additional cover to protect both, as Anna quite rightly said, both the trustees and the sponsors. So I just wanted to touch on some of the trustee aspects on that.
Thanks. Now, other side of the fence, and Simon, what are the insurers thinking about this?
So maybe just pick up on, because we mentioned residual risk versus all risks, and I was involved in all risks cover on a transaction many years ago. And I think all risks has sort of fallen out of fashion because in reality, it doesn't cover all risks. And I'm sure we'll cover it on this call at some point. But, there are exclusions, there are risks that are uninsurable. And I think the promise of all risk cover has probably been sort of mellowed over time, and now we've ended up in this world of residual risk cover. From an insurance point of view, you think I might be quite salesy on this, but we don't actually like residual risk cover. We don't actually sell risk cover, but we know people want to buy it. So we have it there. It is an option. It's certainly not something that we would, for example, if I think about my house insurance and I go and sort out my house insurance policy, and at the very end, you get asked if you want legal cover, you want this, you want that, those add-ons. That's not something we are doing here. Our bread and butter is the kind of core bulk annuity transaction, but we know, and there is demand for it, to be able to add on this cover that, to Anna's kind of well-defined start, it is those sort of unknowns that trustees and corporates worry about that could, at some point, once those benefits have transferred across to us, suddenly kind of pop out the woodwork and there's an issue to solve. So it is, for us, we don't particularly like it. Unknowns, no one really likes, but we recognise there is a market for that. And, we certainly, for the right clients and the right sort of pension schemes, will offer that.
Okay. And also, as part of the question, when we're talking about what are the main indicators for identifying residual risk, you've talked about unknowns there, Simon. Iris touched upon a confidence in the data. I assume putting those two things together, Harris, is that the better the data, the fewer the unknowns will be.
Yeah, but it's not just data. It's also, from a legal point of view, it's do you have all the documentation? Is there that mythical chairman's memo which says we're going to give you fixed 5% pension increases, even though the rules say RPI, which I've actually seen. It's not a myth. I've seen it on pension schemes. And you have to be confident that you've got all the information that you need. And that varies, as I said before, from one scheme to another. It's not every scheme is going to be able to get comfortable with what they have in terms of going into a transaction. But ultimately, it then does come back to what is the premium and the conversation that you have with the sponsor as to how you meet that premium. Either it's can you open a checkbook, or the scheme can do it itself. So it does come back to actually what's the affordability of these deals.
Excellent. So on affordability, we turn to pricing then, Simon. So So we've sort of started to touch upon what the gap the residual risk is attempting to fix. We're sort of in that unknown territory, as you just said. What are the factors that actually impact how you price these sorts of things, Simon? And can that be done accurately, or how do you approach the price of these unknowns?
It's fair to say with residual risk, it's probably more of an art than a science. So if you look at all the risks that we do take on in a bulk annuity transaction, we understand investment risks, we understand scheme data, we understand scheme benefits, we know how much it costs broadly to administer these benefits. We can package that all up and price it in a way that where we understand the risk, we understand what trustees and companies are willing to pay, and hopefully that's a kind of well-worn process. With residual risk, you have very little data to work on. You have very little precedent. You have very little sort of guidance as to what a worst case scenario may or may not look like. So you are effectively trying to make a judgment call on a price, and to Kelvin's sort of starter of that sort of 0.5 to 1% on top of a premium, or kind of the core bulk annuity premium. You're trying to find a trade-off of a price that is competitive and people are willing to pay, and they see that it's worthwhile paying, but then also making sure we've got sufficient buffer should claims sort of emerge over time. So it's not as rigorously defined as it's, say, for the rest of it. And the fact is that, I'm into that, to Harris's point, it is very much about everything that comes out of the due diligence that we will do prior to that residual risk incepting. I'm sure we'll cover it elsewhere, but that due diligence is the key exercise for us. And at that point, we are going through root and branch, the sort of legal side of things, the administrative side of things, the scheme history, and all that side of things. And it's the outcome of that that defines not just the price you pay, but actually also the scope of the cover that you get and what's included, excluded, etc.
So if we think for a minute then about the steps that schemes and trustees can take to basically lower the price and therefore lower the risks that they think they might incur, perhaps make some of those unknowns a bit more known, or at least more predictable. If we start from an admin and trustee perspective, Harris, the starting point might be to just ensure the right benefits. But what is involved in that? You've hinted at a few of the sort of scary things you've already seen. How far should trustees go in that? Because they can't know everything.
So I'll talk to you both as trustee and as an ex-administrator. So it really, again, it comes back to, it depends on the scheme. So if I take a smaller scheme, you may go back to first principles. You might actually go back to recalculate every single benefit that you have, because you will have the ability in terms of the size and the numbers of members that you're dealing with. Would you do that for a 50,000 life scheme? Probably not. You would look at things, but you won't need the same. Simon will know this better than I, but you won't need the same data. So on a small scheme, the fact that you've got spousal data is even more important than on a larger scheme. On a larger scheme, when they're looking at pricing, they may say, well, actually, we'll put some balance of probabilities of how many people are likely to be married. So the frustrating thing for me as a trustee is when we're looking at a buyout, people very much talk about the last 12 months. You can do a lot of the work now in the lead up. Even if your buyout is the next 5 to 10 years, you can still do a lot of the work, because a lot of it is static. Discretions tables, the powers under trustee and rules, trying to find that documentation. The actual data cleansing itself, you can marry up with things like pension dashboard, because some of that information you're going to need for the dashboard, you're going to need to do a buyout for. So you can spread all of that over a number of years. The one which the insurers really want, which is live data, is spouses data. And again, that will vary depending on the size of the scheme as to how important it really is. But we know all that information now. So for some trustees, as I say, they will go back to first principles. Others will take a little bit more of a holistic approach. The problem that we have, as I said before, is when you're moving from administrator to administrator, what generally is sent over to the new administrator is not exits. It's not people who have transferred out of the pension scheme or had a refund of contributions or something like that. It's generally those that they believe are active members. If they active or deferred members, sorry. If they haven't updated their systems, you could have incorrect data going from one administrator to another. If you haven't had people who have transferred out, you may get people coming back later on saying, I've got a claim. So there is the quality of data that goes from one administrator to another is hit and miss. And that's where trustees will go back and say, no, we need to really delve into this. But again, that's on a risk benefit analysis. They will look at it and go, how much risk do we think is there and how much work do we need to do?
Okay, thank you. So I guess in terms of all risk management, it's an assessment of likelihood versus impact, as with all things. Yeah, so legal perspective then, Anna, how can parties make sure due diligence is completed? And at the risk of sounding like some of my developers, what is the definition of done? Yeah, how do you know you've done? Are there various degrees to which you can do diligence?
Yes, yes. I mean, uncertainty is inevitable, and on the data side, trustees don't have to get everything right, but they do have to act reasonably, act in good faith, and do what they can. And we are where we are. They can't reconstruct things that happened that previous administrators may have done, or files that may have been deleted or shredded 10, 20, 30 years ago. So it's really important for trustees to do what they can and have a paper trail that shows they've investigated, they've asked the right questions, and they've clarified things as much as they can. On the legal documentation side, because what we're trying to find out is what is the benefit structure, and the entitlements are a combination of data and, the benefits are a combination of data and the legal entitlements. And so the data alone isn't enough. You need to be looking through the history of the scheme, and many schemes have 3 sets of rules that still apply to the current deferred and pensioner population, and they often seem to only check against one. And what we know from taking on a new client is that it can take us 6 months to get a full set of the rules. And amending resolutions, particularly, don't tend to get kept with the same level of formality. So in the ideal world, you get all the scheme documents going back to day one, and you review them, you work out a member map, how many sets of rules currently apply, make a working copy that shows, can everybody still hear me? Yeah, I lost my picture for a moment there. You make working copies of those sets of rules, showing the amendments, and then amendments to the amendments. And based on all that, you can have pretty good confidence about the content of the entitlements under the rules. You've still got difficulties with retrospective amendments, the Virgin Media case, Section 37 confirmations, and somebody mentioned the promises for senior executives and so on, transferred in benefits, augmented benefits, AVC benefits. There's often no documentation about those. But the gold standard would be bottom-up review of all the docs, make a nice file, and that gives as much confidence as you can get, combined with some legal advice about the validity of those things. That gives you a firmer shape as you're going to get on the legal entitlements. That's a fairly intensive process. And if we're talking about the smaller scheme deal, 0.5% of, say, a £20 million scheme is not, the due diligence is going to cost as much as the premium. But something more needs to be done than the usual kind of benefit spec that administrators have drawn up that may be legally signed off. That might be all right for a BPA, but that's not going to be enough for residual risk. And perhaps in conjunction with insurers, trustees will be able to move into a kind of residual risk light approach where they look at the material financial factors, which are pre and post retirement escalation and the payable age. And so if you pretty sure you've got it right on revaluation in deferment, pension increases in payment, and what are NRA 60 tranches and who has an NRA 60 tranche and how does it behave between 60 and 65. You know, we know where the bodies are buried. Most DB schemes have some problems in those areas, and those are the most financially material areas. So if the gold standard is complete bottom-up review, I would say that's maybe the silver standard of a more targeted review, which would, I think from an insurer point of view, tackle the cohort risk as well, because there's a big difference between residual risk cover that would just pay an individual who brought a claim versus residual risk cover that would cover the cohort of people who might also be covered by the same issue, even if they haven't made a claim. And it's, I think, on the revaluation and pension increases and the Barber windows and stuff, where an insurer would have big exposure. So there are different levels of work that could be done. I think it's important for the trustees and sponsor to work out and agree their objectives, and perhaps then in conjunction with an insurer, work out what cover they could get for what level of due diligence.
Thank you. Before I move on with my questioning, you don't have to keep listening to my voice. If you want to raise any questions of your own, please put them in the Q&A chat on the panel on the right-hand side. We'll get back to those in a minute. But while we're still thinking about what schemes can do to get ready, and what does ready mean, and how detailed do you need to get, let's think about the data itself. So Anna's highlighted a few real-world examples there, Kelvin. What are the challenges about the data and the benefits, and what are the typical challenges, and how can schemes work to the required level of accuracy?
Yes, I guess the biggest challenge faced by schemes when it relates to data is that, and it's been brought out and highlighted by Harris and the other panelists, is data is not static, right? Scheme data is not static. It changes, and to ensure its accuracy, it requires frequent updating. So identifying scheme members, their relationship status, dependents, appendant spouses, ages, and names are core to performing a successful analysis and enrichment of scheme data. So trying to then make sure that you have got the core information related to members' data is a challenge in itself. But the only way you can overcome these challenges is by having good, regular review of data. So having a good governance in the scheme that requires the administrators, the advisors to come together and review the data, and the trustees to review the data on a regular basis. And all of that does take time, and it does cost money, but within the grand scheme of things of what you're trying to achieve with the scheme, which is eventual risk transfer, and if you want to include residual risk cover, then you're going to have to do that work. So that's just on what I call the high level member data. When you start looking at benefits, then again, it's been highlighted. Are the right levels of benefits being paid? What does it say in the trust deed and rules? What has been the practices in the scheme in terms of the application of those benefits? It may be that the trust deed and rules and a benefit specification says, this is one thing, this is one way that the benefit should be paid, but in practice, in reality, what has the administrators been doing in practice historically? And so there could be a disconnect between what is actually set out in the rules in terms of the benefit and what is actually paid. And this is at the heart of trying to understand how much it's going to cost you to get residual risk cover, is being able to go through, perhaps in some cases, first principles and look at the benefits that's on the system and try to replicate them through calculations from first principles and trying to identify any discrepancies, and then being able to explain why there may be those discrepancies. So it's a detailed, involved, non-trivial exercise, and asking for residual risk cover in a transaction only makes only necessitates that you have to do a much deeper dive of all of those issues. But fortunately,
Thanks, Harris. Harris, I think you wanted to come in on that.
Yeah, I just want to echo a couple of points that Kevin made there, which I think are really important. The frequency of reviewing your data. If we look at where schemes have moved from administrator to administrator, from a GDR point of view, the ex-administrator may not hold the data for a very long period of time. So you need to make sure that you've tackled everything. And a lot of that, when these schemes are historic, is actually lots of information may be in archive. It may not even be on systems, because the smaller the scheme, the less likely an administrator has actually automated it. So from a trustee point of view, you should be looking at actually, what have I transferred from one administrator to another? Have I got everything that if I do need to go back into the files, I can actually look at this? The other point that Kelvin raised, which is from a practical point of view, is unbelievably important that trustees look at, is what does the rule say versus what is practice. I've seen many cases where the rules might say one thing, but administrators have actually administered the scheme in a very different way. And then, as Anna will know, we have to go back to legal counsel and start getting lawyers involved as to actually what are the real benefits here, and you know what should we be buying out. And those are two very, very important points. The final point I'd make on this is actually the sponsors. One of my colleagues I can see is actually on in the audience, and he will know that we've seen situations in the past where sponsors have got the information that they've sent to the pension scheme incorrect. One very quick example, which we spoke about when we were in the prep sessions, was a sponsor who hadn't turned the page on a definition of pensionable salary, and the first page said basic salary. If they turned the page, it said plus bonus and overtime. They didn't put that, so all the information we had was therefore incorrect. So it's really then important that you also speak to the sponsor and say, are you certain that the information you gave us was correct? Which is more difficult where a sponsor has changed from time to time as well. So it's those are real points that you need to highlight and think about when you're doing one of these transactions.
It's good to highlight that, Harris, because I remember the scheme, like you, Harris, I've worked in admin as well. I remember as a junior administrator just deferring to the scheme actuary all the time about assumptions about, I think we used to call them administrative easements.
Yeah,
you know, which I think is a collective word for ignoring the rules and just doing what's practical. So I completely get what you're saying. Did I speak over you, Simon? Were you about to come in?
No, not yet.
Fair enough.
Could
okay,
I just say about rules, though?
Yes, Anna, please do.
30 years ago, when we were drafting a set of rules, we'd been working really closely with the in-house administrators and the pension manager, and they knew the scheme absolutely back to front, and most of the members as well, probably. And in more recent times, the process of drafting rules has become really a completely separate parallel track from the administrators, and the admin has never been rebased in the rules, let alone the rules with the overlay of legislation that has been overriding, and that has then changed later after the admin system was set up based on a particular understanding. The two tracks just completely diverged, which is a shame, and it leads to a lot of things that need to be corrected.
I'm conscious that the audience are behaving themselves and asking us questions in the panel. I know you can't read it, Simon, but one of them, first one is to you. So thanks for your question, Ian. I'll read it out to you, Simon, so you know what it says. Does Rothesay unbundle their residual risk premium price to show the cost of their unlimited cover so trustees can compare the cost versus a separate policy from a third-party insurer?
Okay. I wouldn't necessarily define it as unlimited cover, just for completeness. But in terms of how we unbundle it, yes, it is charged as a kind of separate loading to the kind of bulk client policy premium. So you will have a pound number for that residual risk cover relative, that you as trustee and advisors can then compare to what else you can get, or any form of size of indemnity, say, that you might get from the company. So it's very transparent in that respect. Might just be able to pick up on some of the insurer side things from the conversation about how we look at things as well.
Please do.
And I think just want to be clear that actually a lot of the market has evolved hugely. There's 200, maybe 300 buy-in transactions happening a year now. That a lot of advisors and administrators and lawyers, have got to a point now where, as schemes are coming to market, they have done a lot of thought about how to codify admin practice and make sure that the gap between how schemes are administered, what the scheme rules say, ultimately what they want to ensure is those gaps are closed. And a lot of reason for that is there's a lot of demand, and if you're trying to assess whether to quote on one scheme that has thought through those things and has a clear, detailed benefit specification and data to go alongside it relative to one where there are clearly question marks, clearly some decisions to be made later down the line, you're always going to go for the one that has done that pre-work. So that happens mostly regardless of whether it's a residual risk transaction or not. So I think the overlay with the residual risk is just the level of additional due diligence we do as part of the transaction process to get comfortable with what we're presented with. And so it's not just looking at rules, but it's also looking at all of the preceding discussions and circumstances that have come to how the scheme has come to where it is today. So it might be, we're looking at trustee meeting minutes, we're looking at member announcements, scheme booklets, that list of essential documents could be fairly long. We're also looking at evaluation reports, investment reports, administration reports, everything that gives a real flavour for how the scheme's got to where it's got to today. That's the legal side of things broadly. You've then got the data side of things. So, we will be looking at member records, doing individual member calculations, looking at the particularly tricky higher liability members where, as you say, there might be special promises, and really trying to flush out all of that, and also understand the administration history in the processes and the data sources, and what level of automation is there, what have been the key events, and to Anna's point, did the scheme close to accrual correctly? Do they index their pensions correctly in revaluation or in payment? Was there equalisation window? A classic one, but surprisingly common how many still have equalisation issues, even just in that kind of run up to coming to the market. And so hopefully that gives a bit of flavour from us, and it's something that it can be a 6-8 week exercise for us. So it's not a small exercise, and it does take a lot of time, and that is being done in parallel to all the kind of normal bulk annuity transaction work. And just on the pricing aspect, anything that comes out of that is not necessarily affecting that add-on residual risk premium. What it is being reflected in the actual core bulk annuity premium, because data cleansing and any corrective exercises are then flowing through in that core premium. So to kind of separate those two a little bit.
Simon, it may result in exclusions from the cover rather than a higher price.
Exactly, yeah.
Well, that saved me asking Martin's question. So
Martin, that's your question.
So thanks, Martin. So I guess just on Martin's point there that Anna raised, I feel like we're in a similar position that we were years ago when we first started thinking that we could save some money by doing medical underwriting at an individual level. It's sort of like once you've opened Pandora's box, you've got to deal with the information you found, good or bad. So I guess that's the risk of the extra due diligence. Just to touch upon a point you just made there, Simon, in terms of you as an insurer choosing what you are quoting, the schemes you are quoting on, and you mentioned that you're going to look favourably on the schemes that have done their homework. You also mentioned how much extra work this sort of diligence is, and it's still diligence you've got to do in parallel to all the other stuff you're doing. So does that just multiply the importance of schemes being prepared for this and not just seeing what's out there?
Yeah, exactly. And schemes will also have to think about the insurer decision-making dynamics as well. If you've got, again, two plain examples, one without residual risk, one with residual risk as an ask, you're probably going to get more engagement from insurers where residual risk isn't being asked for. Counterintuitively, we might actually opt to choose the residual risk one because we know it's something we're quite good at pricing and doing, and therefore we know we're in a potentially smaller field of insurers offering that. So, but it's just something to factor in. But I don't, to Harris's point, this data cleansing, this prep is not static. You can do it at any point now. Now, clearly, some of it requires sequencing. Some of it is better done when that data is fresh. But the reality is you can do a lot. And one really good example where that due diligence process can be really made more efficient and streamlined on the data side of things is, why don't you just write to members with their benefit entitlement and get them to confirm that that's what they understand their benefits to be. And then, that has multiple benefits. On the one hand, these members, you're hearing from the horse's mouth. They say now they got, can't raise it again. Also, it's a huge amount of data we suddenly just get. We can quite easily look across all of that information and have fairly high confidence in what's being provided. And that can be done, any point sensibly in the kind of preparation towards coming to the market.
Thanks. So we spent time there thinking about what schemes can do to lower that risk on the sort of the inbound journey into the transaction. We turn to actually incorporating residual risk coverage into a BPA deal. So from a legal perspective, Anna, what are the significant challenges that pension schemes would face if they're going to want to add this into their coverage?
Well, I suppose the key choice is it going to be embedded in the bulk annuity contract in detail, or is it an option that can be exercised later on with the insurer giving a quote later on? And it's a much stronger position for trustees to get it embedded in the bulk annuity contract, I would say, because once they've done the deal, they've lost all their negotiating position. And that means front-loading that due diligence, I suppose, and it's all been left to the run-up to a transaction that can get pretty stressful and needing to negotiate several pages of detailed terms. But if trustees want that cover, I would say better to do that upfront. Concessions are more likely to be made, perhaps, in the heat of the negotiations, or by both sides. In the heat of the negotiations about actually getting the transaction across the line. I
know in a simple commercial sense, potentially, we are, as you say, much more engaged. We're looking at the data anyway because it's part of the bulk annuity process, and everyone wants to get it done. Transactions typically don't fall apart at that stage. What we then have to balance is, well, if someone comes buyout and says, well, now I want residual risk, well, how do we balance up all the resource required to do that, where, say it's, 0.5% premium, a £1 billion transaction, it's not a huge amount of additional premium, it's a lot of work, but that resource that we're taking to do that could be going to price another separate £1 billion transaction. So being able to do it all at the same time is, by far, the more sensible time to be doing it.
Yeah, I would agree with that. And I was recently involved for a client in one of the other kind, where the insurer had said, oh, don't worry, we'll give you a quote for residual risk once we've completed the verification and we're approaching the buyout stage of the individual policies. And we must have spent a year going back and forth with drafts, markups of the contract and having debates about what should or shouldn't be included. And ultimately, the negotiation just flopped. And the client didn't take out the residual risk. And I think that when there's no deadline and there's no commercial pressure and there's pressure on resources for the insurer, as Simon said, it's much more difficult to get it across the line. Just another point on timing, doing the due diligence well in advance of thinking about approaching market can really pay dividends, because it's not only underpayments that come out of due diligence, vendor due diligence exercises, there's often overpayments. And if you find that out 5 years or 10 years before a transaction, you can stop overpaying people. Because at the end of the day, when there's commercial pressure to get the deal done, the sponsor may be, trustees may be happy to throw money at problems, and they'll want to write off past overpayments. It's more commercially effective to fix things so you're paying the right benefits in the years coming up to approaching the insurance market.
I would agree with that. And also, for me, look, let's not sugarcoat this. Doing a buy-in, buy-out, these transactions, these are expensive. You know, I'm not just talking about the premium, but actually the work involved, trying to get things watertight as much as depending on what watertight actually means for your scheme. And when you turn to a sponsor from a trustee point of view and saying, let's all do that in the last 12 months, and the figure could be 6, potentially 7 figures of fees, that can actually put a lot of sponsors off. By doing some of this work, spreading the work over, if you've got a 3 to 5 year buyout, say I'm going to spread the work over that 3 to 5 years, you're also spreading the cost. And from a trustee point of view, I can tell you I get more buy-in from a sponsor at that point to do this transaction than if I turn around and say it's a gigantic payment right at the end.
Yeah, and you'd be surprised how often it happens. Well, perhaps you wouldn't be surprised, but it does often happen that trustees, sponsors have got the power to say no to something, to say we don't consent to the early retirement on those terms, or we don't consent to those pre-97 discretionary pension increases. And obviously some sponsors are very well aware of that, but we've certainly, I mean, I remember a case where one of our lawyers pointed out that it was up to the sponsor to decide the early retirement terms, and they immediately decided to change and sorted that out in terms of employee relations and wiped £30 million off their liabilities at their next valuation. So just understanding the framework of the legal entitlements and the balance of powers and who controls what can be very valuable to a sponsor. Why not front load that?
We're sort of in this area already, so let's think about timing then. We've mentioned a few times and described it as the transaction. Of course, a bit like data cleanse, you know, PRT can be a series of transactions, all ending up ultimately to the full buyout. So in your position as an insurer, Simon, when is it best to include residual risk cover? It might just be my ignorance, but, you know, what through the whole run of buy-in through to buyout?
Yeah, so we're thinking more about when that cover actually commences rather than when the work's done, to understand it. So I think you've got three options. So you've got it incepts exactly when the buy-in incepts, so at the point you pay the premium, and that's called a single premium structure, and that is certainly more favoured for schemes that usually driven by corporate activity, who just need to be able to remove as much risk as possible as quickly as possible. So that front loads all of the data cleansing work. Trustees say this is, we're paying one premium, and what then happens is there's then data cleanse work that happens, but there's no true up payment at the end. We price it, and you take the fact that there might be some overs, some unders, but that's the premium you pay. You then have the second option to that is that the residual risk cover still incepts during the buy-in period, so before buyout, but it happens after the data cleanse has been done. So it's been accurately the premium you pay accurately reflects all the outcomes of the data cleansing and correction work. That again is driven by trustee objectives, it's driven by timing, affordability, all of those sort of things. But we are relatively ambivalent as to when that happens. And then the third option is it is on buyout. So you've got to the end of your buy-in period, you're in the process of kind of buying out, issuing individual policies, and then wind up. You can do it at that point. Broadly, the cost isn't particularly different to that, but it's balancing from the trustee and company perspective the certainty around the costs, the certainty around the actions and timing of all the bits and pieces that run in parallel to these sort of things. And also, there might be other activities as well that they're thinking about in that. I think that doesn't detract from the point that we would still want to be doing all of the upfront work, at the exclusivity stage. But when it actually incepts, I think is driven more by kind of overall objectives from the trustee. And I don't know, Harris or Hannah, if there's any.
Well, Chris, you asked about multiple transactions there, I think, and it's a bit of a nightmare from a trustee point of view, I think, negotiating residual risk cover with different insurers, because the one thing that the trustees want is for it to be the same for everyone. And that's very hard to achieve because different insurers will take different views about exclusions. So ideally, you'd get a kind of wraparound cover from the last insurer if you've got multiple deals with different insurers. But again, that may not be readily available.
The other thing about the multi-insurer
early on, I think. Sorry.
Yeah, so the other thing about the multi-insurer deals is it can put off other insurers when you want to go to a new deal, because what have you done the previous transaction on? Was it for the want of a better phrase, was it the juicy benefits? Was it the part that they really wanted? And then there's this knock-on effects. Will you get the same competitive tension, competitive environment for the deal that you later go on? It varies from one insurer to another.
We don't like it, unsurprisingly.
Thank you. Just as a trustee perspective, then, Harris, we've articulated, how much extra work this is, and does add cost to the final premium, and you've got to sort of work out whether that's worth it or not. Are there alternatives? Are there credible alternatives for schemes wishing to mitigate this, rather than just only include it?
Yeah, there's a number. Somebody's been touched on. Kelvin at the top of the call talked about trustees using runoff missing beneficiary insurance. That's quite a common one, and there are limits on that. But the reason why you have those limits is you're looking at, again, on balance of probability and saying what's the likelihood of a claim being brought forward and how much would that claim likely be. So you're not going to find a 60 million fund asking for a 60 million runoff missing beneficiary insurance. It might go for £1 million insurance. There will be limits on the number of times, because the time period of that might be 15 years, because after that you could be time barred on claims. There's a whole load of issues as to why you go for a limited period on those insurances. The other is obviously the employer itself, and again, this was touched earlier, can give you indemnity. But then from a trustee point of view, you're seeing, well, how strong is the employer? Can its indemnity cover if there was a risk later on? So effectively the covenant strength of the sponsor. Simon quite rightly talked about going out to members, and every buyout I've ever done, or buying any deal that I've ever been involved in, I've gone to members and I've said, these are the benefits that we are going to insure for you. And that's irrespective of size. And we've had incredible responses, and that's nothing to do with the comms that we've done. It's as simple as we've put a prepaid envelope. If you make things as easy as possible for an individual to respond to you, they'll respond. And we've seen schemes use their portals. We're saying just log on there, make your life really easy. They will respond, and that gives you a lot of comfort around this. And the final one that I mentioned is actually giving an example of a scheme. I did the smallest buyout I've ever done last year of 600,000 of assets. It had an equalisation problem, and the equalisation, the how the administrators were administrating the scheme and what the rules said, there was a 6-day difference. It was disproportionate for us to actually fix it in terms of the cost involved. We went to the insurer and we explained the situation, and they quoted a higher premium, which was more beneficial to the member. We went with that. Okay, so again, we were open and transparent with the insurers what the problems were, and they said absolutely we will deal with this. But yes, there's a premium for it. Again, you're explaining it to the company, but you're saying from a trustee point of view, it's either we spend this to try and fix it, or the insurer will take it off our hands and deal with everything. The members are effectively getting more benefit than they're entitled to.
Yeah. So just on that, the rounding up the benefits is a good way of doing it. But often if trustees have done all the work, they're really well protected on winding up, and they might decide they don't need any residual risk insurance.
Yep.
And if they're not confident and it's clear that there are a lot of issues, you know, there is another alternative, which is running the scheme on. That is an all risks environment. If you're happy with the employer covenant, it's the only all risks environment. And covered by, if most people are covered by a bulk annuity contract, you've got your sponsor covenant, you've got 2 sets of regulatory regimes, you know, run on can be very attractive in an uncertain situation.
And just while we're on that, time to squeeze in another question from our audience. It's not quite the same point, but again, in that assessing whether it's worth it, Harris, we've got a question from David Stewart from LCP. Thanks for joining us, David. For a scheme in surplus where the surplus belongs to members, how do you assess if residual risk insurance is appropriate use of the surplus?
That's a brilliant question. I don't know if I can answer that in a few seconds. It's I'm trying to think here.
Well, can I start?
Do you want to give me a chance to think about it? It's a great question.
The trustees need to consider whether they've got power to buy it. They wouldn't usually have.
Okay.
The money would have to come from the sponsor. I suppose if they've been in a solvent situation, they can amend the rules to give themselves power to buy it.
Yeah, and that actually is absolutely correct. We've been in situations where there is a surplus. It is, and I'm thinking of one case that we have at the moment. There is a surplus, but the rules itself doesn't allow us to buy insurance via that surplus. And that has to come from the sponsor. It is explicit in the rules. You cannot use it.
Yeah, I mean, presumably from the trustee perspective, Harris, assuming you can go and either augment benefits or have insurance, you're effectively doing a kind of, right, this is my budget, or, you know, my notional surplus I've got to spend. You know, you'll be able to buy some member enhancements. What does that look like? How much is it? If something does go wrong, where are we protected? How much do we want to pay for that? How much have we got? You know, other ways to kind of mitigate that. I think you're probably just trying to not jigsaw puzzle necessarily, but you are probably doing some form of kind of cost benefit analysis and thinking through scenarios and trying to just come up with a best picture. Yeah.
Because unknown unknowns, missing beneficiaries are quite easy to deal with. Trustees can protect themselves. But there's known knowns as well. There's a whole range of different kinds of risks, and spending the surplus on doing something for the people who've been lost or overlooked or underpaid is not irrational compared to giving more to the people that you already know about and you've already secured in full.
Yeah, and it comes back to like we said before, it's how confident are you in the data? How confident are you in the benefits that you're going to be paying, and in terms of how this scheme was administered? If you try to get perfect data, you're not going to achieve it. Okay, you're going to get to a point where you say, I'm comfortable, and therefore that's when you're assessing, do we need to take residual risk? And Dave's question is absolutely correct in terms of, is it insurance or is it other ways that you're actually going to make sure that you can cover that potential?
But trustees are well protected, but another option for completeness is go to the court and say, we've done everything we can. Look, this is their history. We've done it all. Can we have your blessing? There is a procedure to do that. It costs money, but it may be less than a residual risk premium.
Thank you. I'm going to have to wrap us up now. So thanks to David for making sure that finished for us, Larry. Thanks for that question. I'd like to thank all of the experts, not only for being experts, but for meaning that I didn't have to speak very much. So thanks to Anna, thanks to Harris, thanks to Simon, and thanks to Kelvin. So we hope you enjoyed that. If you've got any suggestions for anything else you want experts to talk about in the PRT market, please let us know. But otherwise, thank you for joining us and have a good rest of the day.
Thank you.
Thanks all.
Thanks
Thanks,
everyone. Bye.
Bye.